Sean, talk about the compelling three for a moment. What led you to realize that successful retirement tax planning isn't about having one great account, but having the right mix of accounts?
So we wrote a book last year called, Tax Planning to and Through Early Retirement, and we really look at the lifetime arc of I'm 22 years old, I graduate college, I got my first job versus I'm a widow in my 80s taking RMDs and everything in between. And when we're working, look, save, invest, that's great. But what tends to happen is there's a lot of shiny objects, HSA, RSUs, 401k, Roth IRA, backdoor this. And so we wanted a little bit of a moniker that could boil it down. That, if you didn't know anything else, but you had one moniker, you'd be in a pretty good place. Not that it would resolve every last planning question or anything like that. So we came up with what we call the compelling three. And that's essentially doing traditional 401ks and the like at work, doing Roth IRAs or backdoor Roth IRAs at home, and doing taxable brokerage accounts with the excess at home, especially because our book is more targeted for early retirees. We thought, if you're only doing the 401k and the Roth IRA, you're not that likely to be all that early in your retirement. So we added the third one, the taxable brokerage account. And in today's environment, all three enjoy very solid tax benefits that can complement each other in the first part and the later parts of retirement. Even the so-called taxable brokerage account, people fear that. People worry, oh no, I'm going to have capital gains, and isn't this terrible? Well, if you can get to retirement before age 65, and even if you get to retirement at 65, but especially if you get to retirement before age 65, you could withdraw from those taxable, quote unquote taxable brokerage accounts. And you get two big things going in your favor to start. One is basis recovery, right? Think about if I'm retired and I'm living on $100,000 because I sell my ABC mutual fund in my brokerage account, $100,000 of proceeds. What's my taxable income? It's not 100,000. It's 100,000 less my basis. That basis could be 30,000, 40,000, 50,000, 60,000. So my taxable income might only be 40, 50, $60,000. And then the second thing is the so-called the 0% long-term capital gains bracket, which is very helpful for retirees, particularly early retirees. And then Roths can, this is another one, Andy, that I think all of us advisors need to be thinking a lot more about. Roth distributions in the first part of retirement. I'm old enough to have been in college taking a tax class as an undergraduate when the Roth IRA came out. And the professor back then, he was right. He was like, you should all be contributing to these things. This is so fantastic. And for the Roth IRA is 28 years old this year. And what people have said is build that up, and then never spend it so it can go to the moon and you'll have $10 million tax-free at 90. I think it's time to step back from that last piece of the thinking a little bit to say, well, wait a minute. If I could take a tax-free distribution from a Roth IRA, Roth 401k, whatever it is, when is that tax-free feature the most beneficial? And I think for some early retirees, it might be that when you're saving on both income tax and optimizing, or at least somewhat optimizing for the so-called premium tax credit, taking the tax-free withdrawal might be much better in your 50s than it is in your 90s when the taxes aren't going to be that as impactful. And, oh, by the way, you won't have a premium tax credit to manage for. So I think, on the Roth side, it's time for some of us to sort of reassess when we best take those. Not that we just only take them in our 50s, but I think it's time to say, well, it's okay to spend some of that Roth in the first part of your retirement because it is there for your retirement, and you'll probably still have some later on in retirement.
Sean, you introduce a concept that I think surprises a lot of people, the hidden Roth. Can you explain what that is?
Yes, and that's partly because we live in an environment of very high standard deductions, even something called the senior deduction now. And the sort of the play there is maybe what you do in the first part of your retirement is you spend down the taxable brokerage accounts. But, not everybody has, some people sold a tech company fine. They've got hundreds of millions of dollars in a brokerage account. But that's not most retirees, particularly early retirees. Maybe you have 3 years, 5 years, 7 years in the taxable brokerage accounts. You spend them down first. You take advantage of that basis recovery, 0% long-term cap gain bracket. Then you get to your mid to late 60s. And what do you have left over? Maybe you have some Roth accounts. Okay, that's fine. But most of it's in the traditional deferred IRA or 401k. Maybe what you do at that point is you spend down the traditional IRA, traditional 401k, and you don't claim Social Security until age 70. So what does that do? Almost all your income is a traditional IRA taxable withdrawal. But recall, if you're a married couple filing joint, you have a $32,200 standard deduction this year. Add $3,300 if you're married and you're both 65 or older. Add the potential senior deduction. We could talk about that in more detail if you're interested. That could get you up to, I think, $47,500. And maybe you have a little bit of interest in income, but that's it. So maybe you have $2,000 of interest income. Well, the next $45,500, in my example, would go tax-free against the standard deduction and the senior deduction, assuming your income's low enough. But even if you didn't have the senior deduction, you still have $32,200 on the standard deduction, $3,300 on the additional standard deduction. So you're talking about over $30,000 that you took to live your life out of a traditional IRA, and you paid zero federal income tax. Well, I know what a retirement distribution that I pay zero federal income tax on, that's a Roth IRA. Well, not in my example. It's a hidden Roth IRA. It's a Roth IRA that hides out, that lurks inside your traditional IRA or traditional 401k. This planning opportunity tends to be really, best available sort of in our mid to late 60s. At 70, it's generally going to go away because what's going to happen? You got to claim Social Security. Okay, that's fine. And now you've increased the annual benefit because you delayed claiming the annual benefit, but that will create ordinary income that'll sort of soak up the standard deduction. So for most affluent people, the hidden Roth IRA falls off the table at age 70. But in our 60s, it could be a very valuable planning opportunity. And it's just one more reason to have some money in these deferred accounts. I could deduct at 22%, 24%, 32% at work. And then when I live off of it in my mid to late 60s, I might be able to shelter some of it from federal income tax because of the high standard deduction. And at least for now, maybe even the senior deduction.
Yep. A good opportunity worth paying attention to. If someone watching today is in their 30s or their 50s or even their early 60s, what's one thing that they can start doing now to build the compelling 3 before retirement arrives? I'm kind of curious about how much do you allocate? Do you follow the kind of best practice of you're trying to sock away as much tax deferred as possible, or are you trying to spread it out?
So I tend to think you're best to take the tax deduction now because it lowers the cost of retirement savings. Now, to be fair, if you want to retire very, very early, you're going to need to do a lot more than max out a 401k, presumably. So, but for those who are sort of on the margins, I would argue that what most Americans struggle with in retirement is not taxes, it's sufficiency. So the idea is you just got to build up these assets, and you probably should find the most tax efficient way to do so. I'd argue that most Americans pay most of their income tax when they're working, not when they're retired. That's for a variety of reasons. So take that tax deduction when it's juicy and meaty. And the odds are, look, I can't guarantee any outcomes, right? But I look at likely outcomes, and the likely outcome is that over the course of a lifetime, you'll pay less taxes proportionally in retirement than you do in your working years. So why not take the deduction in your working years? So I'd say that's probably the best play that most Americans have on the table. But that said, there are these other 2 compelling 3, right? The backdoor Roth IRA for the high earner, if you qualify, if you have the right profile, and then the taxable brokerage accounts, which can be very helpful, especially in the first part of one's retirement. So there's no uniform answer, but as a general principle, taking a tax deduction during our high earning years tends to work out for most Americans.
We're going to move on to the next segment, segment 2.